Greetings. Wish I could be with you there live right now, but we'll have to settle for a Zoom session. This is the quiz, the 20-question quiz that was conducted on Friday. Many of you did very well. Some of you not so well. So I want to do a full review of the 20 questions so you will have complete answers. You should have access to the answers as well, but I want to explain each of the questions to make sure we're all on the same page. So I'm going to share my screen. Be aware that the questions are probably in a different order than you have on your exam. So the questions are randomized. But we'll start with the first question that I have here. Revenue is properly recognized when? All right, it's nothing to do with the cash received or the cash paid. It is the third answer there, when goods or services are provided to customers and the amount expected to be received from the customer can be reasonably estimated. You don't wait till the end of the accounting period. It's not when the order is received. It's actually when the goods change hands, ownership changes hands. Let's go on to question number 2. If a company receives $10,800 from a client for services provided, the effect on the accounting equation, let's see what happens. And I'm going to actually go ahead and take a look at the whiteboard. So we're going to take a look at how that works. So I'm going to go ahead and share a whiteboard, and we're going to draw on this whiteboard our famous T account: assets, liabilities, equity. So the question we're at hand that's being asked is, okay, $10,800 is received from a client for services provided, and the accounting equation, what happens? Well, we know that 10.8K added to our equity. The revenue increases equity, expenses decrease equity, investments increase equity. We didn't increase liabilities, but we did increase assets 10,800. What asset did we receive? It didn't really say, but it's either cash or accounts receivable. They were sold on credit or sold for cash. Doesn't matter if we got the cash or not. They owe us the money because they got the stuff. So the proper answer to that question, and let's go ahead and clear that out. And let's go back to the share and take a look at our question directly. And the last item, assets increase 10.8 and equity increases 10.8. So that's why that's happening. That T account goes with that. Let's go on to question 3. If we have liabilities of business increases 101,000 during a period of time and equity decreases by 43. Okay, so again, we still have to match that balancing of the T account. And I'll actually draw right over this screen and insert our T account right here. So if we have our T account on screen and it says the $101,000 in liabilities up, and then the equity decreased by 43, the net of that, if you do the math, you're going to see that we're at, what does it look like, 58? It's a change of 58 in liabilities and equity. So 101 minus the 43. And then if we go look at the other side, that's a 58,000 increase. The other side better have gone up 58,000. So what's the answer? What happens to assets in the same period? Increase of 58,000. Let's go on to our next question. That T account's pretty powerful stuff. Oops. All right, we're going to go ahead. I'm going to clear that, and I'm going to go back out of annotation and move that down. So a company purchases a truck. The seller asked $22,000, but the company paid $20,000 after negotiation. The owner of the company believes he got a great deal, really worth $30,000. What amount should the company records of the financial statements be for the truck? Well, what number can we hang our hat on? Well, 30,000, that sounds nice. Even 22 sounds nice, except 20 is what we wrote the check for. So 20,000, that second answer has to be the answer to that question. All right, internal controls. What are internal controls all about? This is question 5. Not a specific principle. Before the separate right and wrong, though. Procedure to protect assets. That's what internal controls are. We're protecting inventory. We're protecting fixed assets and equipment. We're protecting anything that is an asset of the company. And reliable accounting promote efficiency and uphold company policies. So we don't want things disappearing. Those are the procedures and processes that affect assets. So internal controls are there to protect assets. Cash is usually the biggest one that needs the most protection. It's the most liquid, easiest to disappear. Number 6, accounting equation shows an increase in assets and an increase in liabilities. So what happens if we take a look, what transactions would have caused that effect? So what increases assets, increases liabilities? Well, it's the advertising expense. Actually, that's going to decrease equity. That's out of the picture. Supplies were purchased for cash. Yep, assets go up with supplies, and cash went down for supplies. So that's one asset up, one asset down. That's not what we're looking for here. We have an asset and a liability change. Equipment was purchased on credit. So I got equipment asset going up. I got, credit liability going up. That sounds like the winner. Let's just look at the last 2 answers. Cash received for providing services. No, that's equity up and cash up, asset up. Cash was paid to AP. That's cash down and liabilities down, or assets down, cash, and liabilities down, accounts payable down. So answer has to be equipment was purchased on credit. Number 7. Reported income of 27 for the past year. Beginning of the year, the company had 219 in assets and 69,000 liabilities. And by year end, assets had increased to 319 and liabilities were 94. What is the return on assets? So if we're calculating ROA, if you recall the formula, we'll just sketch it out. You recall that the formula looks something like this. ROA is return over average assets. Remember the average. You have to have that average in there. So what is the return? Well, what's our net income? Profit, return, all means the same thing. So we had 27,000 in return. And we had, what's the total assets? It's the same as total equity and liabilities. So we have a total, trying to figure out what the average assets were. And we have year-end assets had increased to 319. So we have beginning assets of 219 and 319. So we do 219 plus 319 divided by 2. And I can just eyeball that. You're going to add basically 269. So 27 over 269. And actually 27 over 269, that's almost 10% exactly. So around it's 9.9, I think. So it rounds up to 10%. So is that on one of our answers? Sure is. 10%. You got a winner. Ding, ding, ding. All right, let's go clear that and go back to our next question. Question 8. Net income of 195 million, average total assets of 196 million. What's the return on assets? Again, we have the return or net income divided by average assets, which is just nicely given to us. So in this case, actually, the only logical answer here is the 9.9%. So again, you can eyeball that and say, wait, well, 196 over 1960 is 10%. So 195 is just under that. Didn't even need a calculator. Although you're welcome to use one. Company uses 1430 of its cash to purchase supplies. The effect on the accounting equation would be, let's diagram this one out. If we're looking at our accounting, let's go ahead and just annotate the screen we now have. If we're looking to say, well, that T account's kind of cool. Let's look at our T account. And company uses 1430 in cash to purchase supplies. So what happens to supplies? Up 1430. What happens to cash? Down 1430. Are we still in balance? You bet. Net effect on assets, 0. Obviously, no effect on liabilities or equity either. So that's a pretty clean, easy way of looking at things. Okay, let's go on to, we're halfway through at question number 10 right now. Accounting equation shows a decrease of its assets and a decrease in equity. Which of the following transitions can cause this effect? So assets are down, equity is down, which means it sounds like we had some expenses or pulled out some ownership interest. And it looks like we had a reduction in something else. Let's see. Advertising expense was paid in cash. Cash went down, one asset down. Equity went down because advertising expense reduces equity through retained earnings. That looks like a good answer, Ray, actually. First one out of the gate. But let's take a look at the other ones. Company paid amount due on credit. Oh, so we paid some amount due on that was an obligation to pay. So the liability went down, the accounts payable went down, and cash went down. I don't think so. Equipment was purchased for cash. One asset up, one asset down. No, that doesn't make sense for what we're asking. Cash was received providing services. Equity is up and cash is up. That is not the downward question of decrease in assets, decrease in equity. And the utility bill was received for the current month to be paid the following month. So liabilities are up and equity is down. That has nothing to do with assets until we pay it, until the cash changes hands. So we were right the first time that advertising expense for the month was paid in cash. Increase in equity that results from providing products and services to customers are called, bottom line, increase in equity comes from an increase in sales or an increase in revenue. Same term, just to confuse people. And we see revenues and sales. We see revenues there. We don't actually see sales, but revenues are the same thing. So investing, liabilities, financing, expenses. Nope. Revenues is the only one that would fit the description. Now we have another question. Determine the net income of company for which the following information is available for the month of July. How do we determine net income? Well, we take our revenues, subtract our expenses. So we have one revenue item, 420. We have three expense items, 185 plus 15, which is 200. And then we take out another 25. So it looks like, if I'm doing the math right, it looks like 195 in the calculation. Is that available as an answer? You bet. 420 minus the 185 minus the 15 minus the 25 will get us to 195. Next question. If Dallas company billed a client $18,000 for consulting work and completed the accounts receivable asset increase by 18,000. So what's this telling us? They bill a client for 18, the accounts receivable increases by 18, which means we didn't get cash. We sent them a bill. So assets are up. Does this affect liabilities? I don't think so. Does this affect equity? You bet. What part of equity? The retained earnings. And what increases retained earnings? Well, net income increases retained earnings. Expenses decrease retained earnings. As do dividends, by the way. We'll see that later on, but dividends are going to be decreasing retained earnings. So what happens here? We had an increase in revenue. Last item on the docket. On to question 14. Assets created by selling goods and services on credit are what? What's the definition of? We sell goods on credit. We don't get the cash, but we sell stuff and they're going to pay us later. Well, the two answers you would probably think about is either accounts receivable or accounts payable. And we've been talking about this enough in class. I hope you realize that if people owe you money, that's a receivable. If you owe somebody else money, that's a payable, an obligation to pay. In this case, somebody owes you money. Assets created, it's an asset. Receivables are an asset. By selling goods and services on credit, definitely accounts receivable. Question 15. Let's see what we got. May 31st, on my birthday. Current year assets and liabilities of Riser are as follows. Cash, receivables, supplies, equipment, accounts payable. What is the amount of equity in the current year? Well, what do we have for assets? We have assets totaling 12.3, 6750. Shift over there. We got 750 and equipment 11.3. Add that all together. Take away our accounts payable of 8650, and we better be in balance. Because as you know, not only do you have a formula of, and I'll just type it out so it's actually a little more readable. Assets equals liabilities plus equity. But you also have a formula of assets minus liabilities equals equity. Just do the mathematics, do the math. So we take our 4 asset items and subtract our 1 liability item, and that will leave our remainder of equity, which in this case does come out to 22,450. All right, let's go ahead and clear that. Clear drawings. On to the next question. Which of the following accounting principles prescribes that a company records its expenses incurred to generate the revenue recorded? So when do we move inventory from the balance sheet to the income statement? We only move it after we sell the stuff. So we generate the revenue, that goes on the income statement. Then we pull the inventory out, put that on the balance sheet as cost of goods sold, and we can calculate our gross profit. Only at that time, well, expense recognition or the matching principle, we're recognizing the expense to match the proper period, the proper revenues, and that's what we're trying to do. It's not consideration, the cost principle, which is historical cost, business entity assumption, going concern assumption, all important, but this is expense recognition or the matching principle. Going at 17, company borrows 80,000 cash from US Bank. How does the transaction affect the accounting equation? All right, let's go ahead and draw the accounting equation. Assets equals liabilities plus equity. This is key and powerful. So what happened? We got 80,000 cash. So where do we put that? We're going to put that under the assets, 80K. And we incur liability. Let's see. We have a payable of 80K. Are we in balance? You bet. So we have a notes payable and we have a cash up, notes payable up. We're in balance. Life is good. So what does that mean? Our asset went up 80,000. Our liabilities went up 80,000. We're in balance. Life is good. 3 more questions to go. So let's take a look at our chocolate shop. Charlie's Chocolates has accounts receivable of 84,000, accounts payable of 37. Company has revenues of 117,000 and expenses of 81,000. Calculate net income. Well, I'm going to go here. I'm going to switch it. Yeah, I get the answer there too. You can see that. So what numbers do we need from this? Do we need anything about receivables or payables? Nope, not at all. Do we need revenues and expenses? Well, we've got revenues of 117, expenses of 81. 117 minus 81 should give us $36,000. Ding, ding, ding. You got a winner. Yeah. Now, the reason you get more information, just think about it. You're a manager. You're sitting at your desk and you got all these reports or access on the computer to all kinds of information. And I say, what's our profit? You say, well, I can look at my balance sheet. I got a statement of cash flow. Cool. I got a statement of retained earnings. Oh, yeah, I can actually probably see that profit there. But I know what my revenues and expenses are. Those are the 2 numbers I need. I don't need my cash. I don't need my notes payable. I don't need my inventory. I just need my revenues and expenses to calculate net income. Hopefully that makes sense. All right, let's go on. Equity of 329, liabilities of 189. What's assets equal? Let's go back to our magic formula. We've been there down this road many a time. So, but this time, instead of our assets equals liabilities plus equity, we're going to rearrange this formula. And we're trying to solve, actually, back up liabilities. How do we solve that? Well, assets equal the sum of our liabilities and equity. So that's the formula we use. We can solve for equity, we can solve for liabilities, we can solve for assets. And assets, by definition, are a combination of total liabilities and total equities. What does 329 plus 189 look like? I think 518 is a good answer. How about you? All right, let's clear that one out. Finally, go on to question number 20. Saddleback Company paid $37,000 of accounts payable with cash. What are the effects in the accounting equation? Hopefully by now you can tell me. Got my accounting equation. What happens when we pay cash? Cash goes down, $37,000. What else gets relieved? We got liabilities going down. We don't owe the money anymore. We just paid off the accounts payable. All there is to it. So it looks like the answer is smack in the middle. Assets decrease 37, and liabilities decrease 37. That's our 20 questions. Hopefully you got most of them right when you took the quiz. And any that you got wrong, hopefully we have reviewed and have made you more aware. This is kind of a fundamental that you really want to be aware of as we talk about the accounting equation and the flow. The last thing I do want to share with you, and I'm going to take this a little bit along the lines of a mini lecture, is we're going to look at something called the statement of retained earnings. And the statement of retained earnings, spell without a T, there we go, of retained earnings. There are things that go into retained earnings. At beginning retained earnings, we add to that net income, or we subtract net loss. If our expenses exceed our revenues, we have a loss. But if revenues exceed expenses, we have income. We subtract dividends, and we end up with ending retained earnings. A couple of things about our financial statements. We've got a balance sheet. Is that for a point in time or a period of time? Let's think about that. If I asked you, what's my inventory for the month of December? You'd probably look at me funny. Or ask for, what's my cash for the month of February? You look doubly funny. You say, well, on February 1st, I had so much cash or so much inventory. On February 15th, I had so much cash or so much inventory. On just February 28th, or December 31, or December 1st. So we have a balance sheet, which is always a point in time, which is why we're averaging on the return on assets. We have to average the assets. An income statement is a period of time. Why? Because if I said, what's my sales on December 31st? You might look at me funny again and say, Dr. Scott, do you mean December 31st? I got 1 day of sales. Or do you mean the month of December? Or the quarter ending December 31, so October, November, December, or the year from January 1 to December 31. And I would say it depends, other than saying, actually, probably looking for the year. So an income statement is always for a period of time. If you look at our retained earnings statement on the left, take a guess. What do you think? Well, I've got beginning retained earnings and ending retained earnings, and I got stuff happening during the year. That is also a period of time. And the same thing for a statement of cash flows. I have my operating, investing, and financing cash flows. We get into that one of the last chapters in the book. And that is also a period of time. Getting cash, transactions, affecting operations, investing and financing, and at the end. So that's an important point to be aware of these and what it means by a point in time versus a period of time. Because often, a lot of these ratios, if you have a return on assets, return on equity. Now, return is for a period of time. The assets is a point in time, so I have to take an average. Anytime you mix an income statement item in the formula and a balance sheet item in the formula, you need to take an average to go with that. Sometime when we do receivable turnover, inventory turnover, we're going to have to do average receivables and average inventory in those formulas because we're basing that on some other factors from the income statement. But those are balance sheet items. Whenever we have a mix of balance sheet and income statement, we're going to have to calculate an average. Although if I ask for something called a debt ratio, which we'll see in the upcoming chapter, in the next 2 chapters, debt equals total liabilities over total assets. Not average, but total. Why? Because it's both from the balance sheet. So if I look at a balance sheet, I say, you know what? I have I'm going to actually draw this out, sketch it out a little bit. If I have my assets, liabilities, and equity, and I have $100 million in assets, $30 million in liabilities, and $70 million in equity, I'm in balance. My debt ratio is total liabilities of 30 divided by 100, that's 30%, which tells me 30% of my balance sheet is debt, so it's liabilities. 70% of my balance sheet is equity. So if I have an equity to debt, an equity to asset. So this is debt ratio or debt to asset ratio, total liabilities or total assets. So if we're looking at that, the same thing is called debt to asset ratio. And the shortened version of that is the debt ratio. That's the debt as a percentage of total assets. So that's going to conclude our conversation for this, finishing off chapter 1. We're going to talk some more about debits and credits. I've got another video that will be recorded for you to look at. And since I hope you take advantage and are able to review this and see what you got right and what you got wrong. Thank you for your time. Look forward to seeing you in person on Wednesday. Bye-bye.